Okay, folks, we're going to work through the Chapter 2 comprehensive problem, and I'm going to get into an inking mode here. Expand this just a little bit. And to remind you, what I would like for you to do is print out the blank Word document, the template Word document that we're going to work through here. That way you can follow along all this information that you see on my screen, except for what I'm about to write on the screen. You will have in front of you, and you can take notes and put your own entries in and follow along as we do this. Now, Chapter 2 is a very basic consolidation. Remember Chapter 1, we applied the equity method. Now we have a situation that you're going to see where it's necessary to consolidate two companies. Now, the good thing about this is we have a consolidation, or actually the transaction, the purchase where the investor is buying the investee happens at the end of their fiscal year, December 31st. So that's nice and convenient, so we don't have any operations to account for on an ongoing basis. There aren't going to be any upstream or downstream sales. So the good news is we're going to start out very simply, and the authors of your textbook do a good job of kind of crawling before we walk, and we'll add on complexity in chapters 2 through 5 as we go forward. But let's get cracking on this and see what we're up against. In this problem, they give you the account balances, basically a balance sheet of these two companies at the date of the transaction, and Miller's going to be doing the buying, and Richmond is the investee, or the company being bought. And then we give Richmond's fair values over here, and of course that's important because we're going to use those fair values to account for this transaction. Now, before I move down there, sorry about that, let's go ahead and look at what the differences are. We actually have a reduction from cost down to fair value of $10,000 on the receivables. Inventory, which is typical, the market value is going to be higher by $220,000. And on buildings and equipment, again, this is typical also, where the net book value, which is cost minus accumulated depreciation, is less than what the current market value might be. So that's a $100,000 difference. Now we're going to also bring two more things onto our balance sheet for the consolidation. There's really no need to write this, but I'll go ahead and do it anyhow. But to draw attention to it, we've got unpatented technology. Now, the reason that didn't exist on the books of Richmond prior to this time is maybe they hadn't got around to consummating the legal necessities to get this patent perfected, but they've done all this work, and so you can think of it maybe as a deferred cost, but the value, the determined market value of that's $500,000. The in-process research and development is something new with the acquisition method. In the old days, when I used to do this as a controller, you couldn't bring on research and development. It was always expensed, and of course on an ongoing basis you expense R&D cost. But when you're doing an acquisition, you're entitled to say we've got some in process, there's some store of value to it, and you assign a value to it when you do your purchase. Now the liabilities are just coming over just as they are, and so we've now, I think, done a good job of determining what is it we have as far as the market values for Richmond. And of course, Richmond is a company. It's a C corporation. It has stock. It has paid-in capital, and of course some retained earnings to go along with it. But we'll see how we handle this stuff in the consolidation a little bit later on. Now, this problem has two parts to it. We'll talk about the parts down here, but a couple of additional pieces of information. In order to do this transaction, Miller issued 50,000 shares of stock. It's a $20 par. Again, par has no correlation to the market value of that stock, so we just use that to record the common stock, but then the paid-in capital will be in addition to this. Now, the other thing is, as part of the agreement, they agree to pay the former owners $250,000. That's a gross sum if certain projections are met. Now, what they have done is they've done a calculation of the fair value of this, and so maybe they think there's not a 100% probability of that they'll be paid the $250,000. So they have put an assigned value of $100,000 on that contingency. and we'll account for that in the opening entry here. And also in doing this combination, they pay $10,000 of stock issue costs and $20,000 to the lawyers and the accountants, which again, that also happens every time you do a transaction like this. Now, how much do they really pay? How much is Miller giving up? Well, that's where this market value of $32,000 comes in. So if I take that times the 50,000 shares, then I'll get an issuance of 1.6 million. All right, now let's talk about what we're going to do. We're going to illustrate two different things, and so part A, and these are independent and autonomous assumptions. So we're going to do part A first, and then we'll do part B. And so when we do part B, I want you to kind of forget about what we did in part A, because we're going to reset the clock and do it in a different manner, because we're going to make it two different assumptions. Now, what are those assumptions? In part A, we are going to dissolve Miller, or excuse me, Miller is going to dissolve Richmond. So Richmond is being acquired, and the shareholders of Richmond are going to receive shares of stock in Miller Corporation, and the entity called Richmond will no longer exist. Now it may have some trademarks or brands or whatever and continue to operate like a division of Miller, but as a corporate entity, it won't exist anymore. And so that's going to drive our accounting and how we do that to handle that kind of a scenario. Now in the second scenario, that's completely different than the first. We use the same information, obviously, but we're going to account for it differently, because in that situation, Richmond is going to retain its legal status as a corporation, and it will maintain its own general ledger, and have to then therefore be consolidated with Miller. Okay, so let's get cracking on the details here and handle this part A. And actually, part A is not all that problematic. Okay, so we are going to actually record on the general ledger of Miller. We're going to make this massive journal entry, and we're going to bring over essentially the balance sheet of Richmond. Okay, so if you go back to your handout, you'll see that Richmond had $200,000 of cash. So obviously we went to the bank, and I got one extra zero in there. Sorry. Went to the bank and put that money into our checking account. We now have the receivables that we have to start to collect. That's $290,000. The inventory we bring over, again, we're bringing all these things over onto our books at market values. That was $820. Buildings and equipment, so we have to go to our detailed fixed assets and put all these items on our fixed asset ledger, and that's going to be at $900,000. Again, the market value. We'll bring that unpatented technology of $500,000. And then we'll also have the in-process R&D of $100,000. Now I'm going to get to the goodwill in just a second. Actually, I can plug it, and yes, you did hear me as a practicing CPA that I do plug numbers once in a while, but I also can prove it. So that's normally it's okay to plug when you can prove. Now on the liability side, we're going to bring over the accounts payable and the notes payable. They had $1,100,000. I don't know why I'm having a difficulty here on my. There we go. And the contingent performance obligation, remember we valued that at $100,000. And now, what did we do here on stock? This is, again, we're making this entry on Miller's books, okay? And the stock that they issued, remember it had a $20 par, and it was 50,000 shares. So the entry to common stock is an even million. Now on the paid-in capital, remember it was a $32 market value, so that $12 times the 50,000 shares, that's where I'm going to get my paid-in capital number, which is $600,000. Now, obviously my debits have to equal my credits when I make a journal entry, and over here on the credit side, I'm at $3 million. And now, what about my debits? Well, let's look at this goodwill for a second. Goodwill, we have to ask ourselves, what did we pay for this transaction, all this stock that we're buying of Richmond, and we're bringing all this stuff, we're going to dissolve Richmond and bring it onto our books. Well, we actually paid $1,700,000. Now, where did I get that number? Well, the issuance of the stock was 1.6 million, which that's what we have down here. These two numbers together, it's the stock issuance. Now, I also have this contingent obligation that essentially is going to, and what I estimate I'm going to pay is $100,000. That's 1.1 million. Okay. So I eventually am going to have to pay that, and that's my best estimate of what that is. That's why I have to add that together to get the 1.7 million. Now, what is it that we bought? Well, we bought $1,510,000. And what is $1,510,000? If I go back up, there's my $1,510,000. That is my market value of the company. Now, remember from your reading, if you pay in excess of the market value of the identifiable net assets means the assets minus the liabilities, that's the net number. And so on a net basis, I'm getting $1,510,000. And I am giving up 1.7 million. So that difference is $190,000 of goodwill. So at this point, if you want to go ahead and check me and add down all of my debits, you'll see that we now are balanced. And life is good because accountants love debits to equal credits. They don't just love that, it has to happen. And I've yet to see an accounting system that doesn't have an input control. Excuse me, I need one more zero in here, don't I? There we go. If I can make that, there you go. Debits must equal credits or the system won't even take the journal entry. So that has to be the case. I'm going to make sure you know that that's $190,000 of goodwill. Now, a couple other housekeeping items. We've got to take care of the lawyers and the accountants, and so we're going to debit professionals' fees expense, right? Remember that it said we paid them $20,000, and then we're going to credit cash for $20,000. So not very problematic there. And then the other thing we did is we had $10,000 of the issuance cost for the stock. I'm intentionally holding off on putting the debit here. So instead of debiting some sort of expense or loss or whatever we gave up to pay to get the, maybe we did print some certificates. Of course, nowadays you really don't have stock certificates. Everything's done electronically in a database. But our debit here is to additional paid-in capital. Now let's think about why that is. To buy this company, to buy the stock of Richmond, Miller's not paying cash. They're issuing stock, and so we know that stock was valued at 1.6 million. Okay, the market value of it was 1.6, and so if anything we do then that relative to that stock, all we want to just take it against the additional paid-in capital. I don't know if logically that makes sense. It makes sense to me, but that's the reason we're debiting additional PIK as opposed to debiting some sort of expense account. Now, one thing to note at this point for Part A, and remind you, Part A is we are buying the stock, but we are dissolving that corporation that we are buying. And there is no investment account. I didn't create any account called investment in Richmond. I just brought all of these assets over onto my books, to my general ledger. And so the reason that is because that we are dissolving them as a corporate entity. Okay? Now, I don't want you to forget what we just taught you here, but what I want you to do is kind of erase your brain and focus on Part B. What is going to happen in Part B? Well, Richmond will retain its status as a legal entity, And so that is going to make a very different accounting exercise. Some of the accounting is going to be the same, but some will be different. And so let's talk about that. You can kind of see here I'm repeating the stuff that's going to be the same as the lawyers, accountants, and issuance costs. We'll go ahead and throw that in there right now, and so you can do this on your own. It doesn't really bear repeating. We're going to debit the same account, so I don't want to take up your time. So those are the same as Part A. Okay, I'm just make squiggly lines there and so know that you can repeat what we had in Part A. Now this is what I want you to pay attention to. We are now going to create that investment enrichment company. We have to keep track of that because it's going to, the entity Richmond is going to continue to exist. Now we got a nice big debit here. What do I credit? Well, I credit exactly what it was I paid to acquire this stock, and so obviously I issued common stock, and I had some additional paid-in capital from that issuance. And then the other thing is I need to bring onto my books, so that as part of the purchase price, is that contingent obligation, contingent performance obligation. Of $100,000. Now that's going to be a $100,000. That's going to be a liability. These other two accounts are equity accounts, of course. The common stock was $1 million. And the additional PIK was $600,000. Okay, so now I have set up my investment enrichment, and don't forget I've got I do have the same entries have to be made on the legal fees and the stock issuance costs. Now this wonderful thing, hopefully I have that framed properly for you. This is a consolidation worksheet. Now, I want you to get used to seeing something like this. In fact, I'm going to force you, as one of your homework problems, I'm going to force you to create one to solve that problem. That's going to be more in chapters 3, 4, and 5. But in this case, we're going to, the structure of it's pretty much the same regardless of what scenario we have. And obviously we're going to get more complicated in chapters 3, 4, and 5. But normally what you're going to do is lay side by side your two companies, and you'll have your income statement and your balance sheet. Now there's a reason that we're not showing an income statement for a Richmond company, and that reason is that there really is no period of operations. Remember, this transaction was done on New Year's Eve at the very end of our fiscal year, and obviously we're being very simplistic for academic illustration, but there's not even one day of operating activity of Richmond, and we know Richmond is going to continue as a legal entity. So what we're doing over here in the consolidated totals is we're telling the SEC and the rest of the world, we're saying that as one entity, and that one entity, the consolidated group of Miller and Richmond, that one entity has only been in existence for not even a day, and so all of the revenue and expenses obviously will all belong to Richmond. And so what we've done, or excuse me, to Miller. Richmond has had its earnings, okay, and I'll show you down here. The retained earnings is as of December 31st, so all of its net income for the year has been closed out to the retained earnings balance. So I want you to kind of to think about that. Make sure it makes sense, because what you're presenting, as if, remember in the textbook, it's as if it were a single unit. And how long has that single unit, that combined company, been in existence? Well, it's not even been in existence one full day. So that's the reason we don't have any of Richmond's revenue and expenses in these numbers. So the simple thing to do, and we'll go ahead and do this I've done it for you on the income statement, but on the balance sheet, the simple thing to do is we're going to bring these numbers across. And now if we're not going to make any kind of adjusting entry, then we just cross-foot the item. Cross-foot means to add across, and so we'll have $770,000 of cash. Now, what am I doing in these debits and credits that I'm calling my consolidating entries? These entries are not being made on the general ledger of Miller, nor on the general ledger of Richmond. They are being made on a worksheet. And this could be Microsoft Excel, it could be Hyperion, it could be any number of packages that companies use in order to create consolidations. But the fact is, you do not book these onto your GL. You're going to do them. The numbers may change, but you're going to do them every time that you do a quarterly or annual financial statement. Now, what goes in here? Well, there's really only two types in this simple problem. The letter A, we're going to talk about how we're going to adjust our assets and liabilities to get their market values. So remember from our worksheet, when we first opened this thing up, we had a $10,000 reduction in receivables. So receivables now become $1,190,000. We had to write up our inventory by $220,000. Okay, inventory now becomes $1,920,000. And the investment in Richmond, I'm going to get to that in just a minute. Okay, you saw how we recorded the investment of $1.7 million, but I'm going to get to these two letters in just a second. Let's go ahead and finish the easy part, which is marking up our remaining assets. $100,000 for buildings and equipment, which becomes $9,900,000. Goodwill. You saw how we arrived at goodwill, $190,000. Unpatented technology was $500,000. And research and development in process R&D was $100,000. Now, what I've done is the net of all of these market adjustments. It should make sense that I'm going to have to offset that to this investment account. Now, the reason is, if I am going to show the entire world these assets and liabilities, and I'm going to show them because I'm bringing Miller is bringing Richmond into its consolidated group at market value. That market value was part of that investment that I recorded. And because I'm presenting everything as a consolidated group, I don't need this investment account. It wouldn't be right to show it in these consolidated financial statements. So therefore, this is what's called an elimination. I'm eliminating that investment, and what I'm using to eliminate it are these market value adjustments that you see. Now, I haven't eliminated it fully, have I? I still need to make a credit. Well, what do I have to do over here on these equity accounts? Well, the fact is, what am I doing? I'm buying the stock. Miller is buying the stock of Richmond, so I need to get rid of those equity balances, don't I? $220,000 on the common stock, $100,000 on the PIC. PIC, paid in capital. You'll hear that in practice quite often. And eliminate the retained earnings, $280,000. Because again, I've only been in operation for one day, not even a day, as a consolidated entity. So I'm going to close all of the equity accounts, which is $600,000, against my investment. And guess what? The investment has now gone to zero. Okay? Now at this point, I can take a look and see if my total assets, add them all up, and I get, you can check me on this, $14,570,000. And if I then crossfit all of my liabilities and equity, albeit, and I'm going to leave out my brackets here, okay? The reason they have these brackets they're not negative numbers, obviously, they're credits. So I have $600,000 of payables, $4,500,000 of notes payable. My contingent obligation is still sitting there at $100,000. And then basically I'm just going to show, because I've eliminated the Richmond equity amounts, so I'm just going to show my equity accounts for Miller. And then in total, I have 14,570,000. All right, that concludes all the number crunching. But what I want you to do is if you want to relook at the video, but try to understand the key things that we're doing here. We're not showing this income of Richmond because we've only been in existence as a consolidated entity for 1 day. The key principle here is in a consolidation, you will be eliminating that investment against these market value write-ups and the equity that you purchased in the acquiring company. Okay? I appreciate your attention and look forward to future topics in chapters 3, 4, and 5. Thank you.